And today's our guest is Vessi Kapoulian from DBA Capital Group. Welcome, Vessi. How are you doing?
I'm doing great. Thank you so much for having me, Rama.
Thank you. A little bit about Vessi. Vessi has 18 years of business experience that includes 14 years of commercial lending and 4 years of business management, sales, marketing. Vessi started her real estate journey in 2017. Today, Vessi controls a portfolio of investor real estate properties in Florida, Tennessee, and Georgia. Almost 161 doors, 6 properties. Her lending experience has served her well in developing a conservative and analytical approach in assessing risk and investing prudently in real estate in order to maximize returns. Her business experience has helped her develop a solution oriented and execution focused approach, which has served well in asset managing her real estate portfolio. So, with that, Vessi, you want to add anything to your background?
Thank you so much. That was a very detailed introduction. And one question that people ask is, how do I get started in real estate? And started with incremental steps to lead to that background. Really in the residential space by buying one home, then another, and eventually scaling into multifamily. So I do encourage the listeners, it is possible. It's just important to take that first step, which is how my journey into real estate developed.
Awesome. Yeah, we'll go a little bit deep into that one. You started into residential, then transition to multifamily. So you work in corporate side also, right? So marketing, sales side. So why you selected real estate
Mhm.
and why you transition from residential to multifamily?
These are great questions. And just to clarify, I was in sales and marketing initially in my career, eventually transitioned to commercial lending. So that is my W-2 job today. I finance multinational companies. At one point of time, I was more domestically focused. And at that time, big chunk of our portfolio was real estate. Primarily multifamily, commercial retail. So it gave me good exposure to underwriting on the lender side. But how I got started in real estate is what I often like to say is that real estate seed that was planted in me back in Bulgaria during the Cold War germinated. Because at the time, when people talked about investments, they really talked about real estate and jewelry, basically hard assets. And so I always had that at the back of my mind, but took the traditional path that many people take, which is go to school, get a corporate job, climb that corporate ladder. So it wasn't until 2017 that I made that first step. What prompted that was really a desire to build a retirement nest egg and diversify away from the stock market. So that's really how it got started. But I would say clues were all around me. I just didn't see them. With the '08 crisis, later on when my own employer went through a couple of restructurings and I survived those. But it was very painful to see how people lost a big chunk of their retirement savings during the market crash, or in the second example I mentioned, how they were let go unexpectedly, not because they were incapable or not talented. It was just a corporate decision. So I wanted to build that safety nest egg, and that's how I got into real estate, initially with single family homes. And once I made that first investment, that gave me the confidence to proceed with a second one and a third one. And I think that's when the light bulb went on. Oh wow, it could be something bigger, not just a retirement nest egg, but another income stream in addition to my W-2 to provide that safety net. And as I fast forwarded a few steps further and asked myself, well, how do I scale this? It became apparent pretty quickly that I'll have to buy a ton of single family homes, and that would require not only a ton of work, but a lot of time. So really teaming up with other people, both active partners and passive investors, and then transitioning into an asset class where I could leverage my skill set and prior experience. And that's what led me to look into multifamily and further diversify into that asset class.
Got it. Awesome. Thank you. So from mindset point of when you're moving from single families to my multi-family side, walk me through your mindset process. Did you feel any fear, any block, setbacks, anything? How did you overcome that?
Definitely, there was fear and there was discomfort, but I think these are the moments where you also grow a lot, which is getting comfortable to be uncomfortable and really taking action. So the first step for me as I started evaluating that journey was one, talking to other investors that I connected with through meetups and online forums. And one of them did say, yeah, it's possible to get into multifamily and you don't have to wait to get 10 single family homes to make that transition. So it was, first of all, it was that encouragement, and two, getting educated. That's also what gave me a lot of confidence on how to take those first steps, connecting with like-minded individuals and really taking action despite the discomfort. But there was definitely a mental block of, wow, how could I own a big apartment building, whether it's 50 units or 100 units? And again, it's not something that you do by yourself, which is where I could leverage my corporate experience in terms of working with people, building and forming teams. It's really a team sport, not something that you do by yourself, which also helps overcome some of those mental barriers as well, because when you're working together, you're sharing not only the sorrows, but also the joys and successes with the team.
Awesome. Yeah, definitely agree on that. Is multifamily is a team game, and you need to find right partners. So, what step you took to finding good partners, or what steps help you to be successful or starting in multifamily?
That's very important. So I talked briefly about the education and getting a coach, getting into a mastermind, and surrounding myself with positive, like-minded, driven individuals. For me, it does take some time to build relationships. I'm not the kind who would meet someone at a meetup or conference and jump into a deal the next day. So I took my time to make connections with people within that mastermind, and one call often leads to another, and over time you build that relationship. There was also a component of meeting with those partners in person, and you have an opportunity to get to know them as people and humans, and make sure your values also align. So it happened very organically, happened over time. It was probably over a period of 6 months or so. So it wasn't that rapid. But what it allowed me to do is, by the time I had a deal or found a deal, I already had at the back of my mind, well, these are the people I really want to work with, and these are the people I want to approach and form that team when it's time to take that deal down. So again, it's a lot of conversations, making sure your values are aligned, your business goals are aligned, and that you have complementary skills so you can add value to one another versus overlapping that skill set.
Yeah, definitely. You touch very, very important points. Values and goals. Those should be aligned, right? So when you're finding right partners. So how did you find your partners? Is through your mastermind group or meetups or any other sources?
Yes, so it's for the deals that I closed last year, it was through the mastermind. They're both done with partners from there. I do network with a lot of other individuals, so I do see the possibility to have deals outside of that mastermind with folks outside of that mastermind. But really, it really accelerated, I think, that journey, because it gave me access to people that I know, like, and trust.
Got it. Cool. So, and also you have lending background and that helping you to be underwriting a lot of deals, right? Share me some high level, or maybe if you want, you can deep dive into that. So, what are the main things you look when you're underwriting a deal?
Absolutely. So I'll kind of hit the top 6 items where I start, and we can dive into any or all of these as you'd like. I first start with the market and submarket, and making sure that meets the key criteria for population, job growth, job quality, income growth, and then within the submarket, median household income levels, crime rates, poverty rates, because there are a lot of things you can do to improve a property or add value to a property, but you cannot physically move the location of the property. And especially relevant right now during downturns, it's those strong markets I view them as the tailwind that will help push you forward during tough times and propel you further during good times. And then as I go into evaluating the numbers, I focus on the top line, making sure my rent growth, vacancy assumptions are reasonable and in line with market, diving into the expenses. Of course, in each expense line item, but particularly insurance, taxes, and labor, like property management fees. Those are very important to adjust as you take over a property. Number 3 is making sure you have adequate reserves, not only for capex and other improvements you intend to make to the property, but also operating reserves. Number 4 is making sure you have reasonable cap rate assumptions for entry and exit. And number 5 is making sure the debt terms align with your business plan.
Got it. Thank you. And in current environment, how exactly you're underwriting these assumptions? So anything has changed from last year to this year?
Oh, a lot has changed. So in terms of the top line, being very conservative with rent growth assumptions, and in some cases really forecasting flat or no growth for the first year, at least based on what we're seeing at least in my markets. And then being more moderate in terms of rent growth assumptions that are more closely aligned with the historical trend, not necessarily the last 2 or 3 years where we saw unusual, unprecedented rent growth, adjusting for higher vacancy, which could happen if unemployment softens, and that's basically what the Fed has hinted, right, is they would like to see slowing down in the economy in order to temper inflation. Certainly for my market, so I source deals in Florida. Insurance is a very hot topic right now, and unfortunately killing a lot of deals, but making sure I have reasonable assumptions and adjusting for property taxes, which are continuing to increase, right, based on the higher valuations, validating those numbers with third parties, validating rent debt rate quotes, because those are very fluid at the moment. And last but not least, making sure I have adequate reserves, at least 6 months of operating expenses and debt service, and adding cushion for any capex improvements that I am considering for the property.
Okay. Got it. Thank you. So from debt point of view, what kind of loans you're approaching, how your background is helping you to, getting better terms or.
So in the current environment, I'm looking at medium tenors, probably 5 to 7 years, depending on the exit. So if I'm looking at a 3-year exit, I would probably want to have a 5-year term loan just to have that added cushion in case of the market downturn is longer than expected, and giving me that flexibility. Preferably looking at fixed rate debt, or understanding what the prepayment penalties are, and looking to build some flexibility there, or at a minimum accounting for those prepayment penalties in the event of in the example I gave, a 3-year exit on a 5-year deal, for example. So those are probably the key metrics, understanding the tenor and the rate, and especially in the current environment, fixed rate, or to the extent that fixed option is not available, looking at other hedge tools that I can use, although caps are very expensive right now. So again, to the extent the fixed rate option is available, that's preferred. Definitely my experience, to answer the second part of your question, has been helpful, because I can understand the credit agreement, know how to go through it, know what are some points that maybe may have a little bit more flexibility than others, and knowing what questions to ask, and certainly not being surprised during some of the diligence reports that lenders may be requiring, or how they're reading and interpreting those.
Got it. Sure. Let's shift towards properties side. What size of properties you're looking?
So I'm pursuing both joint ventures and syndications, and by virtue of that, looking both at smaller multifamilies, which I would define as 5 to 15 units. Those are naturally better suited for joint ventures, since they're smaller in size, have less capital requirements, less work involved, as well as syndications, where I have an opportunity to bring passive investors alongside with me. In that case, the properties are larger. I would say anywhere from 20 to 120 units. That's kind of the range I've been focusing on. Class B, C+, basically stable value add opportunities where you're not completely reliant on the market or rent growth to bail you out, but have an opportunity to enhance the valuation.
Cool. And what are the ways you're maximizing returns to investors or your group?
So I would say it really starts from the moment you buy the property. It's doing the upfront diligence and being conservative in your underwriting. So one example I would give for the syndication that we closed, first of all, we bought a neutral leverage, not negative leverage. We had huge upside in rents, about $200 to $250, which we have been able to realize, being very conservative in the expenses as well. And because of the proper diligence, because we got the right debt based on the business plan, and because of the conservative underwriting, we're actually tracking well against projections, slightly ahead actually, and that's what allow us to start distributions in month 3 versus month 6, and eventually convert those from quarterly to monthly. So it really starts with the upfront diligence and conservative underwriting in terms of how we've been able to accomplish that and maximize returns for our investors.
Got it. And your business experience has helped you to develop a solution-oriented and execution-focused approach. So share me a little bit more about that. Where exactly you benefited, applying this approach?
Yes, definitely. And when you say solutions oriented, right, I often think of it's not a smooth sailing all the time, right? There are problems, challenges that you encounter. And one recent examples I would provide is for the joint venture property that I mentioned. We were looking to accelerate the lease up process. Even there, we're maximizing rent, but at the same time, we want to make sure we put qualified tenants, even though we were getting a lot of applications through the channels that our property manager was utilizing to advertise. The lease up wasn't as fast as we wanted it to be. So we brainstormed creatively as a group. Instead of just going with the status quo, right? The next question is, okay, if we want to accelerate, how do we problem solve? And how do we problem solve together? And one idea was to advertise on Facebook. And within a week, we were able to fill the last remaining unit simply by virtue of number of qualified applications that we received. So sometimes it's coming up with solutions yourself, but as I mentioned in the beginning, it's a team sport. So brainstorming ideas and eventually selecting one, and again, taking action, going after it to realize those improvements.
Those Facebook ads still worked. Did you guys get quality leads from that?
We did. We got a couple hundred actually interested parties, and from those, we only needed really to get to lease up the last 2 remaining units. So of those, we basically, in a first come first serve, selected the first 2 qualified tenants that meet the minimum income requirement, and we were successful. It happened literally within a week. So I wish we had done this earlier, but you also learn as you go. But it was great learning experience, right? Not only from, oh wow, this idea works, but also not fully relying on the property manager who's right, these are the people who handle the day-to-day, but really taking that extra step so you can be in charge and make sure the business plan is progressing as planned or ahead of plan.
Awesome. So what is your plans next 12 to 18 months? How do you see current market situations? How exactly are you planning to navigate?
Excellent question. I think we are in an uncharted territory, a very fluid markets, and a lot has happened. We're recording this right at the end of March, and we've now experienced not only the rapid rise of interest rate, but recent turmoil in the banking industry. I do see more volatility ahead, at least for the remainder of the year. Probably rates will remain high until the Fed has confidence that they have a good grasp on inflation and tapering that down. And eventually, probably things settling down or starting to settle down next year, and hopefully normalizing by 2025. With that said, I think this is also a great opportunity, probably one we will not see in a long time, to acquire properties at more reasonable valuations. So we're continuing to look for deals and underwrite deals, and as long as the numbers make sense, we'll move forward. We're not trying to time the market, but really get in with properties that make sense where the numbers are strong enough for our investor base.
So how are the prices in your market right now? Is it going down a little bit, or what do you think?
Yeah, the valuations have definitely adjusted. And just to give you an example, cap rates, it wasn't uncommon to see properties selling at 3.5, maybe 4 cap rates. Now they're, depending on the submarket, anywhere from 5 to 6% cap rate. So definitely there has been an adjustment in the valuations. I haven't necessarily seen prices go down, but have definitely seen the spread widen between the original listing price and where deals are shaking out. With that said, there's still a pretty wide gap between buyers and sellers. So definitely deal flow has slowed down. I do see some deals being recycled, so to speak. You saw them 6 months ago, you see them again now 6 months later, of course at a lower valuation that's still higher than where the numbers make sense. So I think probably in the next couple of months or next few months is where the real adjustments will occur, and buyers and sellers will have to come together. Those who don't have to sell probably won't sell. They will just sit tight and wait for the turbulence to pass. But there may be other sellers who are more motivated, either looking to exit non-core markets or pressed to sell due to upcoming bridge loan maturities or the need for additional capital driven by either tightly underwritten deals or the need to purchase or escrow for rate caps, which lenders are requiring in order to mitigate against some of that volatility that we see in the market with respect to interest rates right now.
Cool. Great stuff there. So any personal habits that are helping you to be successful?
I think for me, it's really my faith and having that morning routine. Waking up and reading my excerpts of the Bible, or rather listening. There is an app, the Daily Audio Bible, that I like to listen to. It really charges me up for the day. And then having my, what I call 3 goals for the day, the needle mover, or the one thing I'll have to accomplish for today, and then 2 nice to have goals that I also strive to accomplish, but at least focus on the one that I need to get done for the day. So really getting that morning routine, getting organized and charged up is really something that's been helpful for me and also helped me stay focused and organized.
Cool. Any one personal learning or any one decision that you took that impacted your life positively?
A personal or business lesson?
Any decision that you took that impacted your life?
Got it. I would say, since we are in a real estate podcast, I would say it's really making that first step to invest in real estate. It was scary, but I'm really glad I started. The only regret I have is not starting sooner, but it's helped me build an additional income stream to cover at least my survival expenses, if you will. Of course, I'm looking to grow and build from there, but it's really brings a sense of freedom, not only of creating that income stream, but also freedom to accomplish the things that you want to accomplish in life outside of just your work and professional engagement. So that's one of the best things that happened to me, among others, on the personal side as well, but at least on the business, that's the one I would mention. It's overcoming that fear and taking that first step to make that first investment.
Awesome. And any books that impacted your life?
There are many, but the one that I really remember and really got me started, right, to consider those alternative paths beyond just a W-2 career is Think and Grow Rich. And it's not just about building physical riches, but really more about mindset. It's by Napoleon Hill. And there is a follow-on book that he wrote, Outwitting the Devil, which is about overcoming your own limiting beliefs, your own fears, and really the energy and the importance of your energy and mindset and how it shapes your thoughts and actions and living a rich, fulfilled life.
Cool. And how can listeners connect with you, Vessi?
The easiest way to connect with me is through my website, www.dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve. There's a ton of free educational resources there. My phone number, email are there, as well as a link to my direct calendar in case people would like to schedule a call. I also recently released a complimentary digital book, The Busy Professional's quick guide to investing in multifamily, so people can download that there and be more empowered and better educated investors.
Awesome. And thank you for elaborating DBA. Thank you again. Thank you very much.
Thank you, Rama. I really enjoyed the conversation today.
Likewise.